Hi everybody, welcome to the Parallel Systems broadcast. I'm your host Mike and thank you for joining me for this evening's broadcast where we're going to be looking into the crystal ball and I'm going to be discussing what I think is going to happen over the next 6 to 12 months. Now it shouldn't come as much of a surprise because I've been saying for over 6 months here on the channel and in my audio newsletter that I make for my Patreons that I think we're heading towards a cliff edge later on this year. And I think it's going to likely occur going into autumn and winter. Now, in tonight's episode, I'm going to be laying out exactly why I think that is. I'm going to be showing you the evidence that I think proves that is what is going to happen. And then I'm going to talk about what I think comes next. And we're going to look back towards history to find out what is the best way to protect ourselves from the coming catastrophes that are going to befall us. So to begin with, let's just remind ourselves of how the Ponzi economy works. Because for over 50 years, they've been hollowing out the real economy, which is manufacturing. It's where people are actually producing real things. They've been hollowing that out in the West, and they transitioned us to a debt-based Ponzi economy, which is built around the financial sector, asset price bubbles, and ever-increasing amounts of sovereign debt. Of course, the consequence of all this is there has been a massive wealth transfer from the real economy, from people like you and I, hardworking people, and that has gone to the people at the top of the Ponzi hierarchy, which is people who produce nothing. It's people who simply own assets. We're talking the 1% of the 1%. Now, sat beneath them is the financial sector and the corporatocracy, who have their roles to play in this also. Particularly so since 2008 when the system essentially went bust and we began to enter a monumental debt deflation. Now, why is that? Well, it's very simple. The greed of those at the top led to the system becoming so hyper-financialized and filled with worthless paper assets and debt instruments that any major downturn simply unraveled the whole Ponzi scheme. It was too indebted. Now, of course, we know what happened next to revive the system, which was essentially bankrupt. They decided that they would flood it with liquidity through quantitative easing, and they took interest rates to 5,000-year lows. Now, that liquidity enabled the commercial banking sector to give out credit for essentially no cost to the borrower, which could then be used to speculate and buy assets. Happy days. For over a decade, this is how the system worked, and people thought everything was good. People thought the system was back on track. Of course, it was all a scam. It was a Ponzi scheme. Now, so long as the banks remained afloat and awash with liquidity and interest rates were kept low, then the markets would continue to go up. And this is how the scam worked. And we saw this from 2008, right? That there was this now symbiotic relationship between the central bank's liquidity and the stock market. So every time QE was about to end and the central banks were threatening to tighten monetary policy, what did we see? The whole thing started to unravel again. People started to pull the money out. And sure enough, not long after, we would get another announcement from the Federal Reserve and the Bank of England that quantitative easing was going to be extended. And then just like magic, the markets would reinflate and go up again. So this was a quintessential Ponzi scheme. It required ever-increasing amounts of new entrants, which in this instance was new money in the form of liquidity, just to survive. But the moment some liquidity was pulled from the system, it started to unravel and take us right back to the point of debt collapse very, very quickly. Well, today, the debt is now at the sovereign level as well. So pretty much all of the Western nations are bankrupt, period. And they are lending the money from the central bank, fiat money with interest attached, and they're using that new money to pay the interest on the old debt, which was likely created to pay the interest on debt before that. Again, it's a Ponzi scheme. It's a whole scam. The central banks have essentially bankrupted the entire world with this system. And so now, when this whole thing collapses, it's not just going to be located to the US or Europe or Great Britain or a small number of nations. It will be the whole damn thing that comes down. Now, of course, the reason for that is because it's a global phenomenon and we have so many entities within this system that are so filled with these paper debt assets that if just one of them goes, the whole system goes down. One massive default will default the entire system. It will keep going through the system and the nations themselves are bankrupt now. The sovereign nations, they're bankrupt too. There's nobody to save this system. So when you understand that and you understand why it's been going up the past 10 years, you understand that it was just because of a giant financial fraud. It was creating the illusion of growth and prosperity. And I mean, you literally could have bought anything during that period and called yourself a fund manager and pulled in 10% a year and everyone would have thought you was a genius. But we wasn't a genius. It was just because of the liquidity and the interest rates being taken down to almost zero. Now, If they just take away the punch bowl, by which of course I mean the mechanism just described, so if they take away that liquidity and the ultra low interest rates, then the whole thing collapses. That is all it's based on right now. Now, right now, this is exactly what is happening. We're in the early stages of that. And the reason for it is simple. Central banks have been forced to raise interest rates, and they've done this at record pace. And of course, they're doing this supposedly to fight the inflation, which came from them trying to revive the system once more between 2020 and 2022. Only this time, it required the governments of the West to turn to fiscal policy, and that involved paying people to sit at home on their ass doing nothing, grants for businesses, and then backstopping loans made by commercial banks. So the state backstopped these loans, and they put businesses and business owners into such hardship that they would then be forced to borrow, and they'd entice them to borrow with these government backstopped loans at low interest rates. Now, all of this took place because interest rates were already so low that the central banks could not take them any lower to fix the system that way. Or put simply, there was only one option left: to print money. And by printing money, I mean the old-fashioned way, as in literally printing money, getting it into the real economy. So this was different from quantitative easing. It was more Weimar Republic, and of course this has led to major inflation. Now the consequences actually extend far beyond that, because the current situation of interest rates rising so rapidly also has the effect of popping those asset price bubbles, the everything bubble. It pops that. Now, those bubbles are an intrinsic part to the system in and of themselves. Remember, the Ponzi scheme is made up not just of speculators and gamblers anymore. It's also made up of your pensions, of the commercial banking sector, and ultimately the sovereign nations too. Everything is enmeshed with that system. So if those asset prices go down, well, it takes down the pensions. If the pensions go down, the governments go down. It's very simple. The whole thing is intertwined now. Everything's tied up in it, and falling asset prices just cannot happen. If equities go down, the whole system is brought down. Okay, so now we are stuck between a rock and a very, very hard place, because inflation is breaking the back of everyday citizens who are struggling to afford the things they need the most. And then in turn, the interest rates that have gone up to try and combat the inflation, well, that's breaking the financial sector, because the financial sector is filled with interest rate sensitive assets like bonds and obscene amounts of derivatives, quadrillions in derivatives by all accounts. And this is what's led to regional banks collapsing. So all of the spinning plates are now starting to fall. They're not able to keep these plates spinning. So banks are finding their balance sheets are now going up in smoke. And beyond this, as a result of the rising interest rate, banks of all sizes are now tightening their own lending standards. So they're reducing the availability of credit to medium and large sized businesses. And this has been happening all year long. Now, that in turn is going to destroy businesses and their growth, because they're not able to renew their credit. The interest rates are too high. Okay, so let's just recap where we are. We've got a bankrupt system that's been kept alive only through massive amounts of financial fraud and engineering, ever increasing amounts of debt. We've got inflation in double digits. We've got zero growth. Central banks are now tightening. That's going to pop the asset price bubbles, which, as we know, cannot be allowed to happen. We've got regional banks blowing up, and that's happening because of all the phony debt instruments that they hold, which are now being rendered worthless. And finally, we've then got the banks collectively tightening lending standards as we head into a recession. So what does that mean going into the latter part of 2023? Well, that's easy. It leads to the breakdown of the Ponzi system, because those things I just described cannot all happen simultaneously. So it's going to start to fall apart. And we're going to get to that in a moment. But for all the reasons that I've mentioned, I think it's fairly easy to say where we are heading. And then knowing the consequences of that, I also think it's actually much easier to predict what will happen next. Because the system itself is so ultra fragile, sovereign debt levels are so off the charts, the hyper-financialization is so mega, that everything now is riding on that stock market from going up and never ever going down. Never going down. And of course, that situation is quite simply untenable. The only way to keep this thing going at this point is to enact strategies that are going to be highly inflationary, like we have already seen the past few years. And of course, that little taste, well, that is just a taste. This is only the beginning. The other option is to simply let it all crash. But like I said, this is not going to be a crash, not even as bad as it would have been in 2008. It's far, far worse than that. It's worse than 1929, prior to the Great Depression. So we are talking complete financial meltdown, and this is simply now unavoidable, both mathematically and historically. There's no way out of it. Now, as it stands, This is where we are heading, and it won't take very long for us to get there, to this collapse moment or a final reckoning with this system. Okay, so let's take a look at Exeter's pyramid just to imagine what that looks like. First and foremost, we've got 2 to 4 quadrillion in derivatives in this system. Now those derivatives are all bets, and they have got no collateral backing them. It's essentially paper promises to pay somebody else. Now that means somebody's going to lose, and 2 to 4 quadrillion, well, that's an extraordinary amount of money that is backed by nothing. So at some point they're going to blow up and there will be a debt collapse. Now of course that gets pushed onto the banking sector because they are holders of those derivatives. So when that happens, the banks will start to default. When the banks default, nobody can pay each other, governments will default, and on it goes through the system, and the whole thing would get wiped out. So it would involve the destruction of the financial sector, the bankruptcy of nations, the collapse of all social programs and entitlements. Your pension, all those paper assets you've got, well, they're all gone too. The stock market, that's gone. Then it would lead to things like supply chains for food, medicines, energy, goods. They'd all collapse. Nobody would even be able to pay one another. Everyone would be stuck. Everything runs on credit, runs on debt. So the whole system comes down. You've got mass unemployment, the inability to transact with one another outside of archaic systems of trade and barter. So we're talking a real Mad Max scenario here.
Right or wrong, we had a deal. And the law says, bust the deal, face the wheel.
Bust the deal and face the wheel.
Now what arises out of that? Well, we don't know because we've never seen it happen on a global level, but we have seen it happen in individual societies. And historically speaking, it leads to societal collapse. So we would see societal collapse in multiple regions of the world. We'd see war, revolutions, mass starvation. And the only way that this could be avoided at this point is for them to come up with some plan to do a controlled demolition of the system. And that would need mass social controls. And so far as I can tell, that is where we are heading. But that too will not be clean and it will not be pretty. Things are far too complex and corrupt. The people enacting this are far too corrupt for this to take place in a manner that is not extremely damaging for everyone. Now, if all of that sounds too extreme and too impossible, it's likely because, to put it bluntly, you have no idea what you're looking at. And I don't think the people watching my channel are in that camp. My audience do understand this. But for anybody who thinks that, I would advise you to simply read history and try and make sense of how this system functions, because when you realize how it got us to this point where we are now, you also understand that it's broken and it cannot continue. You can look at my other work, or you can look at the work of many other people out there, some very bright and talented people, and they will describe the same predicament that I'm describing here in this video, this rock and a hard place. So one more time, just to put a fine point in this one, why we are heading towards this cliff edge later this year, it's very simple. Interest rates have gone up very sharply, very quickly. Those ultra low interest rates were needed. We don't have them anymore. Central banks are tightening. That means they're withdrawing liquidity. Whenever that happens historically, the markets start to break. If the markets start to break, everything goes down anyways. We've got a banking crisis that is not over yet. We've only seen the first round of that. I think we're going to see more of that. We've got banks doing tightening of credit. So credit standards are being raised and they're not lending money. Again, if money is not being lent in this system, the whole thing will come down. Of course, we're entering a recession too. And we've got global debt levels at record levels. So central banks right now are completely trapped. They're essentially in an out of control vehicle. It's careering down the road. You know, when you see somebody lose control and they swing to the left and they swing to the right and they're skidding everywhere and they're trying to regain control of it. Well, that is exactly what it's like. Now, on the left-hand side is a cliff edge, and on that cliff edge is a debt collapse, which I've just described. So if they go off that side on the left, they're going into that debt collapse. Now, on the right-hand side is hyperinflation. And if they spit off to that side on the right, they're going to hyperinflate the currencies. So this car is out of control and it's skidding, but they can still spin the wheel.
Bust the deal, face the wheel.
Bust the deal and face the wheel.
It's not like they have zero control. They can spin the wheel towards the left and it will career them towards that side, or they can spin it towards the right. And at some point, they're going to go off one side. It's going to be the debt collapse or the hyperinflation. So yes, we are skidding towards that left side. We can fall off the left cliff and they could let us go into this collapse moment where the whole system comes down. They could choose to do that. But just imagine how that would play out based on what I've already said. And what would that mean for their authority? Do you think anyone would ever trust them again? If they survived that is. I don't think they would. Now, for a time, it's actually useful for them to career us to the left, because as they do, we start to see deflation. As you start to enter a collapse, you go into recession, it can bring inflation down. Then they can all sit around a table in a room and pat themselves on the back and say, see, our policies worked, we brought down inflation. Now, of course, average Joe and Jane on the street don't understand that the only reason inflation started to come down is because the system is about to come down. They don't understand that. So that is where we're careering to at present, but the chances of them going over the edge and taking us right over into the full collapse are small. Now, it could happen, but it would require a miscalculation on their front. And of course, at any point, they have the power to just turn on the printers and backstop the system with newly created money. Now, that would involve a sharp spin of the wheel to the right, which of course now takes us towards the hyperinflationary cliff edge. And that is in essence what I think will happen. They're going to take us close to the edge on the left and then spin us straight back to the right. Once they start to lose control of it, they'll try to take us back to the right. They'll print a ton of money, and there we go towards the hyperinflation. Now, why is that? Well, it's very simple. It's because that is what always happens, or almost always. They tried something else in 1929 and we got the Great Depression. Now, in this instance, it's the most politically palatable thing to do. And remember, both sides are not equal. The right-hand side of the carriageway, the hyperinflation, that gives them more time because hyperinflations play out over a few years. If you go to the debt collapse and that happens in winter, well, it's done. It's over. And then we're in that crazy dystopian Mad Max world. So for all intents and purposes, the outcomes are the same because the hyperinflation eventually ends in a debt collapse anyways. So it just gives them more time, and I think they're trying to buy time so they can get the next system up and running. So the collapse is going to happen no matter what, but it's just a case of when, and I don't think they're going to be doing that going into winter. I think we're going to get close to it, and then they're going to spin us back to the other side, and we're going to have something that allows them to print a lot more money. So I expect that once the pain sets in and maybe we see a sharp decline in equities, we might see them fall 15%, 20%, maybe even more. Then we have inflation start to come down because we enter a recession. Joblessness goes up. Well, I think at that point, they're going to start to get a little bit panicked. They're going to say, look, our inflation's brought down, but then they know they're going to have to bail out the system once more because they don't want banks blowing up. They don't want massive hedge funds blowing up because that could have unintended consequences. That takes us to the full collapse, which I don't think they want. So at that point, something's going to change very quickly and they're going to step in and they're going to have to print more money. And this time it's going to be far, far greater than we've seen before. Now, in case you haven't noticed, it gets bigger every single time. Just look at the US and the rate they're piling on debt. It took them over 200 years to get us to 10 trillion. And now they go through $1 trillion in a year. Between 2021 and 2023, they spent 3 trillion. They added 3 trillion to the debt ceiling and it was gone. Now they've just upped it again. $1 trillion. How long's that going to last? $1 trillion now might last a year, maybe less. Now, it's worth just stopping to pause for a second and reminding ourselves that the average man and woman on the street has no idea what is going on. And to get them to accept the massive amount of money printing that happened last time, it needed a huge crisis to precipitate it to convince them that it was something that was necessary. So last time, it required this huge narrative. We got told there's a deadly pandemic sweeping the globe. It mysteriously appears whenever you meet your friends at the park and you're with your family, but then it disappears at a BLM protest, and now it comes back again when you go to the toilet in a restaurant, but it disappears when you sit down at your table. You probably know the one I'm talking about. Well, it took a narrative as big as that and 2 years of all of that crisis and chaos and all of the toll that took on people. It took all of that to justify the bailout of the system and force people and businesses into taking a ton of new credit on top of government-backed programs to get the fiscal stimulus that they needed. Now, if you go back to August 2019, BlackRock actually released a white paper and it was called Dealing with the Next Downturn: From Unconventional Monetary Policy to Unprecedented Policy Coordination. Now, you don't hear this spoken of much today, but this was a very important white paper because this was just before all of this kicked off. And they discussed in this exactly what the central banks and the governments of the world were going to do in the next downturn that just so happened to be a month later when the repo market spiked. Now, let me just read you a section from that paper. There is not enough monetary policy space to deal with the next downturn. The current policy space for global central banks is limited and will not be enough to respond to a significant, let alone a dramatic downturn. Conventional and unconventional monetary policy works primarily through the stimulative impact of lower short-term and long-term interest rates. this channel is almost tapped out. 1/3 of the developed market government bond and investment grade universe now has negative yields, and global bond yields are closing in on their potential floor. Further support cannot rely on interest rates falling. An unprecedented response is needed when monetary policy is exhausted and fiscal policy alone is not enough. That response will likely involve going direct. Going direct means the central bank finds ways to get central bank money directly in the hands of the public and private sector spenders. An extreme form of going direct would be an explicit and permanent monetary financing of a fiscal expansion, or so-called helicopter money. Explicit monetary financing in sufficient size will push up inflation. Without explicit boundaries, however, it would undermine institutional credibility and could lead to uncontrolled fiscal spending. So essentially what BlackRock was saying there is that the central banks and the governments are going to come together and they're going to tie up fiscal and monetary policy. They're going to print a ton of money. They're going to get that into the real economy, and then people are going to go out and spend it in the real economy, and that's how they're going to bail out the system next time round. And the reason for that is because interest rates are already at 5,000-year lows and they can't go any lower, so they can't fix it that way. Now, like I said, just a few months later, COVID hit, and lo and behold, everyone had to take credit. They started to give people money for sitting at home. The central bank was lending the government money, and the government was putting that in the hands of businesses and in the hands of spenders. And so it went. And of course, just like BlackRock said it would, it led to inflation on a massive scale. Now, remember the timeline. This was released in August 2019. 1 month later, we had the repo spike and the Fed beginning secretive quantitative easing. And then just after that, we had the global pandemic simulation, which was with the Bill and Melinda Gates Foundation and the WEF. This was called Event 201. And they all sat around a table and they predicted exactly what was just about to happen. So it's a very interesting timeline of events. So all of that came true, but we've discussed this already, and my point is simply this: it took something major to get us over the line and to a place where people actually would accept what was essentially the Weimarization of the West. So what do you think is likely going to have to happen when we have this big downturn going into winter and Q1 next year? What's going to have to happen to get them to print more money in the same manner? Well, it might be that there's a crisis brewing right now. So I would advise that you stay alert for that one, because something might be coming on the horizon. But let's fast forward just a little bit further, and don't forget, next year is a presidential election year. So I expect this one particularly to be one of the most messed up American elections in history.
Groundbreaking Asian Americans like Vera Wang and Joan Shingang, I'm going to pronounce right, Shanga Kawawa.
And whilst it ultimately doesn't matter who they put in the White House in terms of direction of travel, given they are all owned by the same people, what we usually see in year 4 of the presidential cycle is an attempt to keep everything afloat financially. So that might mean whatever happens quick, early in the year, and then they get the money printers on. Now, of course, the reason they do that is because they want to protect the president that's already in and to try and get him re-elected. That's usually what happens. But either way, it's coming. So let's carry on our thought exercise to see what happens next. So they didn't take us off the left side of the cliff. They veered us back towards the right. They're printing money. Now credit is being doled out again. And lo and behold, the S&P is going up again. Having had some of the froth taken out, it's now climbing up again. It's a miracle. Nobody understands why, but it's going up. Well, we understand why. We know why it's happening. Okay, so let's try and make sense of this in terms of asset prices, because we've already discussed what happens if they don't go down this route. It's basically game over. And in that instance, well, let's just say your life's about to get a lot more interesting. But in my view, like I said, we don't see that scenario play out. It could happen. Prepare for it for sure, because either way, you need to be prepared for what's going to come. That is going to happen at some point. But let's imagine they kick the can down the road and they give themselves another year or so and take us towards the other side, which is the hyperinflationary scenario. So I'm certain we're going to see inflation come back with a vengeance, but in truth, it's probably not going to leave us all too much in the interim. Not unless this hypothetical crisis that precedes the next round of money printing also has attached to it some kind of global lockdown or shutdowns again, which could happen. Remember, they added this tool to their toolbox in 2020 and 2021. People are psychologically conditioned for it. So maybe we'll see that again, because that could actually suppress inflation for a longer period of time than just a recession. just long enough for the stimulus to be created and used, and then due to the lag in inflation, that inflation that comes from the next round of money printing might not really bite until after the presidential election. So that could actually be the timeline. They lock everyone down, there's a global crisis, inflation then really does come down, then they have the election, they're printing lots of money in that meantime for whatever the crisis is, and then that inflation doesn't come until after the presidential election. Remember, last time it took a year or so for all of that newly printed money that they did for COVID. It took about a year for that to work its way through the system, and it wasn't until 2022 that people saw what people like me was warning them of in 2020 when I saw the mechanisms that were being used. I was saying this is inflationary. There's going to be huge inflation coming in the next year or so, and of course it came about 1.5 years later. Okay, so that's just one scenario, but it doesn't have to happen that way. There's many ways it could happen. I'm not predicting it happens that way. All I'm saying is that's one potential timeline, but they could just have this start to fall apart going into winter early next year and then say, right, we're going to turn the money printers back on. Maybe they don't even need a crisis this time. I just think it's more likely they do. But whether they do or they don't, we know inflation is coming back, and that could happen as early as next year. So this time, I think it's going to be much higher. And in my opinion, it's going to be a chronic situation. So going back to what BlackRock said in their 2009 white paper, which was very interesting, they said we are now in an extreme form of going direct, which is the permanent monetary financing of fiscal expansion. Now, if you watched Mike Maloney's Hidden Secrets of Money series that is on YouTube, it's a fantastic series, you'll know that he called for this a decade ago, that eventually they would simply go to helicopter money. So all of this was foreseeable. The only thing that was not entirely predictable was, of course, the timeline, as is often the case. Now, this is where it's actually most useful to use that 10,000 foot view, and that's how I think about everything. I zoom out and take that big all-encompassing view, because then I can make decisions, and as this narrative unfolds, I can be nimble and change my theses as we go along. But so long as you get that 10,000 foot view right, you can make the right decisions. You can prepare yourself and then just be a little bit creative as you go along. So to understand how this plays out, we have to look back at different past periods in history in which inflation was rabid. Now, we could just analyze some of the many hyperinflations that have taken place, and I've done this in the past. If you check out my video on the Mississippi bubble, for example, that one will give you a lot of information as to how it played out in France in the 1700s and some of the parallels that we've got in our current system. But let's just take it back one step, because there's some people out there who are going to argue that we're not going to go to hyperinflation. And they think we're going to have some kind of Hail Mary, which will take us to this period of high inflation for the next 10, 20 years, but it's not going to be a hyperinflation. Now, I think given everything that I've said, that's an impossibility, because the system's so fragile that at some point they're just going to run out of bullets and they're going to have to print the money and we go to hyperinflation. I think we're already there. I think that's what I've been describing on my channel ever since the beginning, and everything that I said would happen has happened and continues to happen. So that's just my theory, but other people have different ideas, and that's fair enough. So let's entertain them, and let's just look at times when inflation has shot up to very high levels. So let's not talk about hyperinflation. Let's just talk about very high inflation. Now, that's happened many, many times throughout history. One period in which that has happened very often is during times of war. So war is, of course, almost always inflationary, and we've got many good examples of this throughout history. The bankers love a good war, which is why we've had many, many thousands of them throughout history, and they only get bigger and bigger and more profitable. But if you go back to, say, for example, the American Civil War, by the end of that war, the Union side had inflation of around 80% because of all of the money printing it took to finance the war. Now, 80% is high, but it wasn't as bad as the 9,000% that their opposition in the South had. But looking at the global economy today, it looks very much like we have a collection of war economies. And many of the countries have the same debt burdens as a country at war ends up with. So this skyrocketing sovereign debt, that's what it looks like after a war. We've also got high inflation, debt monetization, the merger of the state and the corporations. That all happens during war too. So really, it does look like we're in a war economy in the West. You can say in Great Britain, you can say in America, in Europe, they all look the same. Of course, there are some stark differences too, which I've already highlighted. This is a global Ponzi scheme. It's become an unsolvable Rubik's Cube, and all this fragility that's in the system means that unless everything goes up forever and we find a way to inflate the debt away along the way, then it's all going to crumble. So there is differences. This one's much bigger, much scarier. But if we go back to look at some historical examples, it will at least allow us to draw parallels that could help us now. So during World War I, for example, the largest powers, which were Britain, France, Germany, Austria, Russia, Hungary, they were spending collectively 50% of their GDP, which turned out to be around $3 billion per month back then, on the war. Just think about that for a second. 50% of their collective GDP on war. So the question comes, how do governments, how do countries finance themselves when they're so heavily indebted and they need to keep raising money to keep something going? In this instance, it was the war. Today, it is, of course, to keep the whole system going. Well, it's very simple. They pay for as much as they can in taxes, but of course, they can only go so far with that because taxation will lead to an internal revolution if it gets too high. So for most countries, that was between 5, maximum 15, 20%. So whilst taxes did go up, and so will ours, the rest of it was paid for in the same way. It used the same mechanism that's being used for thousands of years, going all the way back to Rome, when they were clipping coins, ancient Egypt, Babylon, and beyond. And that is, of course, currency, debasement, and inflation. They turned to their central banks, who simply printed the money for them. And of course, this is why banks exist, period. It's to lend money to desperate nations so they can increase their own profit and enrich their wealthy 1% of 1%ers. That's how it works. And if you watched my recent episode on the City of London, which I would advise you listen to, it's from my podcast, the Parallel Mike podcast, which you can check out. I sometimes upload some to my YouTube channel, but I would download it on your podcast app. You can check that out. That episode tells you a little bit more about that. So it's just the same as what we've got today. We've got desperate governments who need as much money as possible to keep this system going, which is essentially like going to war. They need to keep the war going, and that is why they need to keep having money printed. And they're going to do that by getting the central bank to just monetize their debt. That's what's going to happen. Now, in the past few years, the monetary base in countries like Great Britain has expanded something like 20-30%, America also. And again, this is just like the start of a war. It's just like in World War I. So during that time, for example, in World War I, the money supply in Great Britain, that rose from $5 billion to $12 billion. And the impact of that was prices increased by 2.5 times. Now, during that same period, Germany expanded their monetary supply by 400%. That left prices 10 times higher than they had been pre-war. In France, it was up 350%. Again, that led to massive price increases. Now, the reason I'm telling you all of this is because the period we're now entering looks so similar to this period. It's where the monetary supply is being increased. They're doing deficit spending. They have the central bank just printing the money, and they are essentially sacrificing the currencies so that they can keep the system going. In that case, it was the war. In this case, it's keeping the system itself going. Now, if you look at what happened to asset prices during that period, it gives us a good insight into what we're going to see also as we pursue this path of debt monetization to stop the Ponzi scheme from collapsing. So now let's go to France and we'll compare what happened in 3 asset classes. So let's see what happened in the stock market, in government bonds, and in gold. Okay, so let's look at this one. So this is the war returns for France, one of the biggest economies in the world in the 1900s. And let's start with this one so you can see here it's World War I. Now, in the first category here, we have nominal returns, then we've got real returns, and that's for stocks in this category. In the second one, it's a 3% government bond, nominal and real. And in the last one, it's gold, nominal and real. So let's start here. So this is January 1914, and you can see it starts at 100, so that's 100% of the value. Now, if you go down the nominal one, you can see the nominal value of the stock market in its entirety was 108, so it had gone from 100 to 108. Not massive returns, but it had gone up. However, what's most important is to look in this category. This is the real returns, so this is the returns after inflation. And what you can see is it was down to 34% of its original value. So that means that anything you bought with that money from the stock market, yes, the nominal value had gone up, but it was buying you much less. So its real value had gone down. Okay, now let's look at this category here. This is a 3% government bond, and you can see in nominal returns, it went down in value, so it lost 5% of its value. But if you go to this category here, you can see that it lost 70% of its value in real terms. So again, it got destroyed if you was in government bonds. Okay, now let's look at the final column, and that's of course gold. So we've got gold beginning at 100% of its intrinsic value there, and by the end of the war, nominally it had gone up to 304, so it had gone up over 3 times. But now let's look at the real one. This is the real returns on gold during World War I in France, and you can see this time, rather than lose 60-70% of its value like stocks and bonds did, that gold retained almost 100% of its value. Okay, now let's do the same thing for World War II. Let's just have a look at this one briefly. So you can see in the first column that we had stocks. Now, this is going from 1939 to 1949, so this is over the course of a decade. So if you go down here, you can see that nominally, stocks went up over that decade in France by double. So it went from 116 to 215. So nominally, it looks like it had moved 100% up. But if you look at the real returns, just look at this. It went from, of course, 100 down to 14. So those stocks lost 85% of their value in a decade. Nominally, it had gone up, but in purchasing power, you lost 85%. Now, if you look at bonds, this is really dire. So we start up here at 100. Nominally, it went down to 82 from 100. But if you look at the real returns, they lost 95%. 95% of their value over the course of a decade. Now let's go to the last category, which is gold. You can see again, nominally gold went up dramatically here. So gold went up all the way to 1,857 from 100. And in real terms, just look at this, in real terms, gold went up by 20. So gold actually increased its value in real terms. And if you look at some of the numbers that were happening throughout this decade, you can see at a time, gold was up in real terms 647. So that means the value of gold had gone up 6 times, 4 times here, 5 times, 6 times there, and it ended the decade at 120. So gold was actually buying you an awful lot more in France during the war years, which means the value had actually gone up. So what you can see here is that during a period of mass currency debasement, yes, you do have asset prices going up. They go up across the board because, of course, money is being debased. So nominally, everything is going up. However, in real terms, most of these assets are cratering in value. So what does that mean for us? Well, what it means is that if they continue down this path, which they're going to, there's no other choice, we could very well see the S&P break out. It could go to new all-time highs. And then we could have this melt up that people keep talking about. But what does that really mean? Is the S&P gaining in real terms, or is it just nominal? Well, looking back throughout history, you can see that it's likely not to go up in real terms. It's more likely to go up only nominally. Now let's just remind ourselves for a second of where the stock market already is. We've got Nvidia valued at 1 trillion, at 200 times its earnings, which means it would take 210 years just to break even. We've got Apple. Apple is valued at 3 trillion. $3 trillion for a phone company. Now, of course, if they're inflating away the currency, these stocks could continue to rise. And you might see Apple, for example, go to 4 trillion, but maybe in 5 years, a 4 trillion valuation for Apple is actually fair value because the currency has increased so dramatically. So that is something that we could see. Of course, the actual value in terms of purchasing power of Apple at that point is going to be far, far less than it would be today. Now, of course, the lesson from France and from many other periods in history, like the Weimar hyperinflation, is the way you protect yourself is by going into gold, an asset that cannot be printed and that retains its intrinsic value. Now, of course, you hear some people say, well, gold's not an investment. You see loads of people on YouTube. I saw a video just the other day. It was this guy. He was saying gold's not an investment. It's a terrible thing to do with your money. It is not an investment. And I saw somebody else. Somebody shared a video on my private Telegram group for patrons, and they said gold's a bad idea. It's not an investment. These people don't know what they're talking about. They have not read the history. They haven't looked at monetary history. Gold is an investment if you put your money into it at the right time. Now, if you go back to France in 1914 or France in 1939 and you went to store your wealth in gold, what happened? Well, yes, gold went up nominally, but in real terms, it stayed the same. You never lost anything. It preserved your wealth. Now, everything else was going up nominally, but they were also being destroyed in terms of real value. Gold was not. Gold remained the same. So stocks, for example, they lost 85% of their value. Bonds lost 95% of their value. Now, just think about it for a second. If you had your wealth in gold at that point, at the start of those wars, by the end of it, everything else had gone down 85-90%. And you had gone down 0%. You'd kept 100% of your purchasing power. So what does that mean? Well, that means you're now buying assets up at a 90% discount than you was just 5 to 10 years prior. So you didn't need your gold to go up in value, although in World War II in France, it did go up in value. And I think going forward, it's going to go up in value. I think it's going to get revalued for all of the reasons that I spoke about in my previous video, which if you haven't watched, please go check that out. It will give you a really good understanding as to why gold is going to become so important and almost certainly going to need to be revalued at some point if the West want to participate in the next system. But putting that all to one side, if you have your wealth stored in something that protects your purchasing power, whilst all of these mega bubbles start to collapse and we see the hyperinflation, then the revaluation of these assets at a much lower and fairer price, what does that mean? Well, what it means is you're going to be able to pick things up in a fire sale. Now, this collapse is going to be far worse than anything we've seen in history. It's going to be far worse than those scenarios I've already mentioned in France or through past hyperinflations, because this is going to be global and people are going to be selling assets in a fire sale. Now, history is very clear on how we protect ourselves on this one. We need to be in something that cannot be printed, that is not a paper asset. We need a real asset that cannot be printed and is outside of the system with no counterparty risk. Now, that bit is critical. And of course, history has shown us time and time again what that asset is. And it's gold, it's the precious metals, silver also. So I hope you enjoyed this analysis. If you did, please let me know in the comment section if you agree or disagree with me. Do you agree with the solution? Also, if you did enjoy it, you will certainly like my newsletter. I release that every month on my Patreon. The last one just come out. It's an audio newsletter, so it's like a podcast. It was 1 hour 40 in length. And in that, I discussed all of the things that we're talking about here. I also discussed gold, BRICS, Janet Yellen's visit to China, and I also give my patrons value alerts. So this is an alert to something that I see in the market, whether it's a company or an asset class that I think is undervalued, and I see a good risk to reward opportunity. I gave them a value alert on Sunday, and the company that I mentioned, well, that was up 17.5% in just 5 days, and the sector that I mentioned as looking like a very good value opportunity, the sector was up about 15% also. So that's just a little idea of what we're doing over there. We've also got the private Telegram group where we all interact and help one another get prepared, share useful information. I think community is going to be extremely important going forward into all of this craziness. Just a final reminder, I also do wealth preservation consultations. This is where I help people get themselves in order. So we talk about the financial strategies, hard asset portfolios, and of course getting yourself practically prepared. So location, food, water, energy, all of those things, geopolitical risk. So if that's something that you would like to discuss with me, please check out my website under consultations or just get in touch with me via my email address. In closing, hope you're all having a fantastic weekend. And of course, I will see you all in the next one.